Marcus, thank you so much for joining us. We're at a very busy Super Return International here, 2,300 people in attendance. Is that a sign of where we're at in this industry at the moment?
Well, it could be a sign of a cyclical top because, as many of the speakers have noted, valuations are quite high. It also could be a sign of an industry that's delivering returns in a pretty low interest rate world. And private equity has generated alpha over very long periods. Pension plans need to meet their obligations, and private equity is one of the few places, and alternatives generally, one of the few places can do it. And that could be a secular trend that this conference could be reflecting.
So how have you seen this industry evolve over the past decade? Because it has changed, and it's changed in reputation as well.
Yes, I think compared to 2007 and 8, a lot more was reliant on debt funding. People were borrowing 8, 9 times EBITDA to get deals done. A lot of it was financial engineering. And I think the industry has become much better at thinking about businesses on the left-hand side of the balance sheet rather than the right-hand side of the balance sheet. What can they do to improve the business? And most of the leading private equity firms have invested a lot in their capabilities on the portfolio operations side to further those efforts. And so, private equity is not a price taker. While general public market multiples may be high, private equity, through their own actions, can improve the profits of a company, make additional acquisitions, and buy down that multiple. And I think that is one of the biggest changes that's happened, not just in the last 10 years, but it's been a gradual evolution in the last 30 years. But the industry gets better and better at operating businesses, and that's a healthy thing, because that should be and is the main source of alpha creation for the industry.
So it's a coming together of expertise and opportunity.
Yes, I think the expertise is there, and the opportunity set is being somewhat constrained by high valuations and high public market trading levels, but there are always subsectors of things that are attractive to do. And when you ask about what's different between now and 07 or 08, in that period, there were a lot of club deals that were done. 5, 6, 7 private equity firms would team together, and our advantage being a large firm was somewhat nullified by all those firms teaming up. That model was discredited when the financial crisis happened because effective governance is very difficult when you have 5 partners around the table. What's different now is if you're a firm like ours that can write a $2 to $4 billion equity check, there's relatively limited competition for the larger deals. In addition, large deals are complicated, especially corporate carve-outs, and counterparties are much more willing to engage in a bilateral negotiation because it doesn't lend itself to an auction process with an investment bank in the middle, having 5 or 6 people trying to do a complex carve-out. So there are pockets of opportunity like large-scale buyouts, like energy, like Asia today, whereas in 2007 and 8, everything felt expensive.
Tell me about those opportunities. Where do you see the key ones lying going forward?
So we talked about large-scale buyouts. That is a key focus of Blackstone. We take advantage of the scale we have as a firm to pursue those big deals. Energy is another great area. If you think about it today, energy companies are voracious users of capital. The debt markets are largely closed to companies that aren't big producers of oil. If you're an earlier stage energy company, you cannot borrow. The public markets are shut to them. And so they have to get capital from somewhere, and private equity has been able to step in and fill that gap. So I think the energy sector is a very interesting one for private equity today. India and Asia ex-India are also very interesting. The debt markets in India are very thin. Companies are growing very, very fast. The IPO market is only open sporadically, so private equity has a big role there, and our returns there have been excellent. And in Greater China today, the imposition of capital controls has limited the competition we're getting from Chinese companies that used to buy companies in Hong Kong or abroad. And so we've had great success in the last 12 months in Greater China because of those capital controls and because of the increased role that private equity can play in those transactions. So, as I said, there are always pockets of opportunity, and you need the scale and flexibility to take advantage of it.
You talked there about scale and flexibility and being able to be nimble, because the contradiction is, although you may be a big firm, you've still got to remain flexible and nimble, haven't you?
Absolutely, yes, absolutely. Steve Schwarzman likes to say, in finance, a proprietary idea has a half-life of about 6 months. And it's absolutely right. You've got to keep evolving. You've got to keep improving. We try to have a very large funnel through which we get as many ideas and many opportunities globally as we can. And we try to pick the best ones at any point in time that make sense. And You have to keep communicating with our other businesses, with our other offices globally to make sure we're ferreting out what is the best opportunity at every point in time.
And you've talked about also embracing technology as part of that.
Yeah, I mean, I think technology obviously is a buzzword that a lot of people are talking about today. One of the things we talked about earlier on is a lot of firms are scared of technology because they hear about e-commerce decimating the retail sector. But most technology and most of corporate America thinks technology is a big positive. If you talk to the CEOs of our companies, they view technology as a big enabler to allow them to improve productivity and improve margins. And we're very, very focused at Blackstone in making sure our portfolio companies, our industry groups, and the firm really embraces technology and uses it well to improve the performance of our companies. And we're spending a lot of time and money and using our scale to do that.
What would you see as genuine concerns at the moment in the industry, and what do people have to feel cautious about?
Well, I think I've been through 4 cycles before, and every time it was very high debt levels, the shutting down of the high yield market, and the spillover effects into the equity markets that caused the downturn. I don't think that's going to happen this time. People have been much more prudent, and the Fed and the OCC have limited lending, so you don't have the 8-9 times leverage. It's pretty much been capped at 6.5 times. So I don't think it's going to be like other cycles. I don't think it'll be debt that causes this downturn. Everyone looks to a repeat of the previous cycle. I don't think that's going to happen. I think the biggest danger really is multiples coming down. Multiples of companies are very high today, and when interest rates rise, which they eventually will, when there's a recession, which there eventually will be one, multiples will come down. And the best antidote to that is to make sure you control the earnings trajectory of the company you buy. That through your own internal efforts, through your portfolio operations group, through acquisitions you effect, you can continue to have strong earnings growth and to be able to outrun, frankly, the multiple compression that will be inevitable at some point in ensuring good returns for our investors.
Now, just on a slightly different note, we've talked a lot about the evolution of the industry, but what do you think about the industry's reputation on a wider scale? So things like what the public think of private equity now compared to, say, 10 years ago. And do you think the adoption of better attitudes towards things like ESG has helped with that?
I think there's always a lag between popular perception and reality. And I think the industry suffers from that lag. I think most people continue to think this is an industry that somehow has some financial engineering orientation. And I can tell you as a practitioner, the entire focus of the industry now is on the left-hand side of the balance sheet, what we can do with businesses. I don't think that has made it into the public domain to the extent it should. If you think about the fact we've generated 700 basis points of alpha a year over 30 years for our investors, there must be something there that does that. But it's obviously not as exciting to write about. The things we do operationally, it's nitty-gritty, heavy lifting kind of things that probably don't sell newspapers as much as some of the more sensationalized things that are written about. But I think over time, including the ESG initiatives that firms like ours take very seriously, that will be recognized, and I think the industry's reputation will be reflective of the reality, which is I think we're doing a lot of good things to make companies better.
So takeaways today, you obviously had what you had to say on stage and there was a room packed full of people. What do you hope those people will take away from what you had to say today?
I think a lot of the things that we've talked about just now, which is the industry is not a price taker of high multiples, that we can really control our destiny by improving operations, making add-on acquisitions. The technology is a friend to the industry and to the corporate sector. And that you've just got to keep relentlessly pursuing those things to improve performance. And I think the industry really is doing that. I think the industry has learned its lessons from 07, 08. And I think time will tell. As I said, there will inevitably be a correction of some kind, but I think the industry will come out much healthier than the last cycle was.
Prakash, thank you so much for sharing your insights with us today. Great to speak to you.